The last deal I worked on when I was an investment banker was real estate investment banker was a $1 billion skyscraper. So I went from that to a 800,000, like a basically $1 million mobile home park in Kansas. So completely opposite ends of the spectrum. And I was way scared, way more, fearful with the mobile home park because I just didn't know what I didn't know.
Yeah.
And really, due diligence is kind of an art.
Everybody, welcome back to another episode of the Richard Geek podcast. Today we have Brad Johnson. He's a leader in mobile home park investing. He's a co-founder CIO of Vintage Capital. He has 20 plus years experience across traditional and alternative asset classes. He has a unique perspective as both a former operator and current allocator in the mobile home park space. And we'll get into the difference between what he used to do and what he does now. And get this, ladies and gentlemen, he's closed over 3.3 billion with the big B in commercial real estate acquisitions. How you doing?
Doing well. Thanks for having me on, Michael.
So yeah, I'd like to start the podcast a little bit. I don't. Let's not go back with some of these people. Go back to kindergarten.
Sure.
Give us a little brief history of who you are, where you came from, and how you got involved. Your kind of uh, where'd you start in real estate, and how'd you get involved with mobile
Yeah,
homes?
I started as just in my 20s with a couple of buddies buying stick-built homes and fixing them up and renting them out. And was doing that as just as a way to invest capital outside of the stock market, get some diversification. And we would pick cities that we thought we wanted to go visit, like Nashville and Palm Springs and Austin. And we thought it'd be a great idea to go visit the property, be able to ride off the trip and then have some fun. So there wasn't a whole lot of thought from an
Yeah.
investment strategy. Not a lot of demographics went into that analysis, but it ended up working out. And so took that experience and parlayed it into a more real estate institutional background where I went and worked for a private equity firm and then worked on as a real estate investment banker as more of an analyst doing large deals. And that's where I really cut my teeth on real estate. I mean, it was fun doing, the small investments one off, but really where I learned kind of the basics was doing large deals in San Francisco with foreign sovereign wealth funds and private equity groups, and then decided in 2013 that I wanted to be an entrepreneur, go get back to that my roots and actually own and control the real estate, and knew that I wasn't going to be able to just jump into $500 million deals like I was working on with these large groups. I needed to kind of backtrack and go with something that was nichey, a little unique to be able to raise the capital being younger at the time. And so I went with mobile home parks because I had seen a lot of loan portfolios come together where they had the highest yield from just a cash flow standpoint and the lowest default rates. And so I'd always be like, why are you guys including mobile home parks in these loan portfolios for these Wall Street loan securitizations, these big pools of mortgages? And they just said, well, we like the fact that it does that. It increases the revenue and decreases the risk. I'm like, well, those two things should be opposites. They shouldn't go together. So left and built a portfolio with a partner of 2,300 pads, sold that in 2020 around COVID, and have been putting money to work as a limited partner and as a minority GP in the space since there as more of an allocator.
And it's so fascinating. People, it's sexy doesn't usually make the most money,
No,
and mobile homes is definitely not the sexiest. I have so many LPs, and Mike, I don't want all these things. I want to say that I own a hotel. It's sexy. And I'm like going, okay, well, if that's the only reason why you're wanting, I'll take your money, but talk to us. The thing is, mobile home parks, people just don't realize it. They're like, oh my God, I wouldn't be able to go on. They have all this. They've watched too many movies, I think.
sure. Yeah, it has a stigma, and people think trailer park, right? Which is
Correct.
the lowest part of the segment. So we rate them 1 to 5. A trailer park's
Yep.
a one. A retirement community on the water with bocce ball and pickleball and a gym that looks
Yeah.
like a subdivision is a five. So
Yeah.
we like to play in the three to, sometimes four space where, it's affordable housing.
Mhm.
It's certainly not luxurious, but it's nothing close to a trailer park. So that, it's really about quality, safety, and affordability.
Mhm.
Yeah, that's the place we play in. And the stigma is useful from an investment standpoint, right? Because it reduces competition.
That's
So
right.
there's not, you know, I know, maybe three guys in all of Orange County that focus in my niche, right? Whereas if I wanted to go compete in apartments, there's
Yeah.
thousands of guys in Orange County where I live that are doing hey, I buy an apartment, I fix up the kitchen, and I try to bump rents, 3%, right? So we
Yeah.
play in a different space. It's just not as efficient.
So tell us about why does mobile home parks, there's a little bit different. I know some of them where maybe you own the home. Sometimes they bring in a home or they put
Sure.
uh, the mobile home. What are the different types of mobile home parks? We kind of looked at that, ladies and gentlemen. It's kind of like the A class, B class, C class, D class, and
Sure.
multifamily. You have the different classes that Brad was talking about with 1 through 5. Um,
Yeah.
Talk
With
to us a
park-owned
little bit
homes,
about what they do,
yeah.
like the owner or renter, and then what you do.
Sure. So it's a spectrum. We have some. The majority of them are all tenant-owned homes, where we own the land, the roads, the pipes, right, the driveways. Maybe there's some amenities. Most of them, there's not a ton of amenities outside of maybe a park, a playground, sometimes a pool, and a small community center. That's like the extent of the amenities. But most of them, the tenants own the home. We take care of the grounds, right? And so there's no ongoing maintenance really. The ground doesn't have issues, right? There's no
Right.
big capital project with the ground. The biggest capital project tends to be repaving the roads. Sometimes you'll have leaks, right, with the pipes, but for the most part, the capital is very light once you're past stabilization, right? Once you've gotten the park to 100% occupancy, if it was a value add deal, the ongoing capital is quite low, which is one of the reasons why I love the space. But there are opportunities, especially in the southeast, where the home park owned home game is more prevalent. It just was more, I don't know, it was is more of the business plan to control the homes. And part of that was just because the lot rents were really low in the southeast for a very long time. So the owners were like, I can't actually make any money with $150 lot rent, right? I need to be
Yeah.
at the $400. And, maybe 15 years ago, that was harder to get there, right? Today, it's a different story. But so they would say, okay, maybe I can just buy the homes when a tenant leaves, and then I can get a larger home payment on top of that. So in the Southeast, there's a fair amount of parks where maybe 50%, 25% of the homes that are in that property actually belong to the mobile home park owner. And one of the big value add plays that we see quite often and love is when you go into a park like that, and over time you get those homes off your balance sheet, and therefore you increase the buyer pool and you increase the lender pool that is willing to lend on that asset, which obviously increases the price.
Yeah. Yeah. Here in Arizona, we see a lot of the over 55 will be the kind of retirement community and type of with those mobile home parks. But then you also see where there's some RV hookups within those.
Sure.
Do you do any of those types of
Yeah.
diversification?
Yeah, it's more ancillary. It's not the primary goal because RVs obviously can leave in the middle of the night, right? It's not unlike a hotel. The vast majority of them in a market like that are not. They're de facto mobile homes, right?
Mhm.
Where that tenant is, they want to be in Phoenix. It's not like it's a man camp in some oil field where they're there for 6 months and then they're going to blow out, right? But you have to recognize that yes, that tenant could leave, right? If for whatever reason they lost their job and they felt like they couldn't make that payment. So the lenders don't like it as much. So I wouldn't
Mhm.
want to do a park that was say 50% mobile homes and 50% RVs in a soft market because the seller is going to try to get you to pay for all of those lots as if they were all mobile homes. and the lender's not going to give you credit for that.
Yeah.
So if it's once again a great location, like I owned a park in Spokane, Washington once where it was like 30% RVs, and those RVs never left, right? They might as well have been mobile homes.
Yeah. So let's talk about, people are listening or looking at maybe being the LP or, getting involved with you. Um, Something that's important is they're going to say, well, it's all about taxes. Can I get deferred taxes? What's in it for me, other than maybe a dividend? So let's talk about a little bit about the tax advantages of real estate in itself, but also mobile homes and how it
Yeah.
compares or differs.
Yeah, that's obviously one of the main benefits of real estate is that it's a very tax advantage strategy. In particular, mobile home parks, because a lot of the actual asset, the value is attributed to the land infrastructure. That's 15-year property. And so 15-year property you can bonus day one. This is now assuming that 100% bonus depreciation comes back. It's currently in the Senate version of the tax bill. But we'll see if it actually gets implemented. I think it will. But assuming that comes back, you can accelerate 100% of that 15-year property, which is oftentimes 60% of the total value of the purchase price,
Mm.
day one. And that's counterintuitive because you're thinking about it. Well, aren't you buying isn't it a land investment? But yeah, we talked about what actually is that land investment. It's the actual infrastructure to be able to make it a mobile home park, as opposed to the physical structures, which is the homes, which the tenant owns. So that's one of the unique advantages of mobile home parks. Oftentimes, the LPs will be putting in $1 investment and they're getting $1 of paper losses that first year with that 100% bonus depreciation because of the cost segregation study that you would do to break out those values. And I know hotels have similar benefits because of all the personal property as well. It's a great tool for that asset class too.
Yeah, it is. It's as long as they allow it, we'll do it. It's that's the one of the bonuses of being an LP. It's people that have never invested in, ladies and gentlemen, this all across real estate. Um, you kind of thought about it, you kind of, wondered about it until you get that K1 and you're like going, oh, I need to call Brad or Mike up and say thank you. Especially if they're in a high tax bracket. I have investors in California that are like going, oh my goodness, you know.
Yeah,
So
it's great.
they really, yeah,
It's
it's really, really great.
it's definitely a nice benefit, and it's especially a benefit I found and the deals that we refinance, return capital, and then we keep long term, right? Then we don't have to do the bonus depreciation recapture.
Yep.
That's where it's extremely powerful. Like there's
Yeah.
some groups that will try to flip these things, which I just don't understand. And that's why we tend not to work with a lot of private equity groups. I have in the past to do these deals, but the problem is they want out in 3 years. They are not driven by tax benefits. Their investors are endowments, their foundations, their pension funds. They're non-taxable. So they are IRR driven. They want to get in and they want to get their money back out as fast as possible, rinse and repeat. Because that's a much easier way to get an 18 IRR is when you're doing quick deals quickly.
Yep.
Whereas I'm more motivated by long-term equity multiple cash flow growth and after tax returns.
Yep.
So I would much rather get a 13 to 15 IRR over the long term than a quick 20. Because you got to pay taxes, you got to do the bonus depreciation recapture, which hurts, right? If it's
Yep.
2 years. And then you got to figure out, okay, where does that money go now? Where's the next deal? So there's some cash drag there too. So it's very inefficient to continue to recycle deals every 3 years. Whereas if you feel like you're in an asset class that you can hold long term, ideally 10 plus years,
Mhm.
then you can really start compounding that equity multiple and you can grow the cash flow over time, hopefully get a refinance or two to reduce your risk. So that's more our model, which is why limited partners and family offices tend to line up more with our strategy, our viewpoint of the world.
Yeah, it's good. Now let's talk about some due diligence, before we get into what you're doing
Yeah.
as a company. Um, what's the difference between some of the critical due diligence that people I've been in multifamily, I've been in single family. What's this guy doing?
Yeah.
The
Mobile home
mobile home
parks. Yeah.
spot.
Yeah. I mean, honestly, the first deal I did, I was scared to death because, I had done diligence on industrial, office, multifamily apartments, right? Large deals. The last deal I worked on when I was an investment banker was real estate investment banker was a $1 billion skyscraper. So I went from that to a 800,000, like basically $1 million mobile home park in Kansas. So completely opposite ends of the spectrum. And I was way scared, way more, fearful with the mobile home park because I just didn't know what I didn't know.
Yeah.
And really, due diligence is kind of an art, right? It's art and science. You obviously have to, check the math and make sure that, the permit's in place and the rent rolls say, what they've represented in the broker package. Or if it's an off-market deal, you got to get all the bank statements, right? So you got to check the math. But there is the art part of it is really knowing what to not overlook, but just to be like, okay, I see that risk. I know what it is. I can bracket it, and it's not a deal killer.
Yeah.
And so with mobile home parks, it tends to be more about that than like getting nitpicky over a $5 difference in the lot rent because these things they're pretty rare, right? There's only 40 to 50,000 of them. Maybe there's only 10,000 in the whole country that would kind of fit that buy box of something you would actually want to own. And they're owned often by mom and pops. And so mom and pops don't have perfect records, right? They don't have audited financials
Yeah. Oh, yeah.
and pristine tax returns. Like oftentimes they're trying to shelter income from the IRS because they've owned it for 30 years. They've blown through all their depreciation. And so they're putting in the car payments for all their kids and everybody's health insurance, even though they've never even seen the property, right? So really with diligence in mobile home parks is just making sure the bones are serviceable, right? So the roads, the pipes. So you're getting somebody out there to scope the lines. You're making sure that the power is such at the property, the amps are going to work for new homes. You want to make sure that that there's not some crazy boundary survey issue, right? So really, the nice thing is that you don't have to do it all. You just have to find the vendors, the experts in their field to come in and help you review all these things. The biggest gotchas are really around permitting and the city to make sure the city's not trying to somehow get rid of this thing, right? Because cities, even though it's a nice looking park, cities still don't like mobile home parks in their town oftentimes, right? They'd rather have it be redeveloped into a shopping center or something. So every once in a while, you get a city that is actively making operations difficult. So you definitely want to go talk to City Hall, talk to the building inspectors, get a feel for how that park has been operated. You'll also get a feel for the tenant base by talking to the city, of course, right? And then it really, comes down to just verifying things. And right now, we get a lot of seller financing, which is almost like a shortcut for due diligence. Because obviously, if the seller who's owned the thing for 30 years, he still believes in it, she still believes in it, and is willing to put up 50% in a seller note that you could, not pay if they've been lying to you, right?
Hmm.
Make that loan payment difficult for them, right? That is a pretty big statement and a pretty fast way to get comfortable with the asset during due diligence, I found.
Yeah, that's fascinating. And you would think that with this whole thing with affordable housing, that it would almost be the opposite. I guess maybe it depends on where you're at, but this type of it's considered a small home. You would think that they'd want new development. Um,
Yeah. Yeah, well, they should because we have a housing crisis in this country.
yeah.
And really, it's kind of just a part of it. The problem is that if Pops has owned this thing for 30 years and that's has been his only source of income, oftentimes mom and pops are not reinvesting back into the property. And so
Hmm.
maybe there's deferred maintenance, or maybe they've been casual with collections. So the tenant base, right, needs to be upgraded because they just are kind of
Yeah.
taking advantage of that situation. So oftentimes you come in with some excess capital, you reinvest back into the property, improve it. Then the city's relieved. They're like, oh, okay,
Hmm.
this is a professional operation.
Yeah.
And I've been involved in some developments in Texas, which is actually a place that you can get things approved in the mobile home park space. And yeah, these look like subdivisions.
Okay.
So you would be totally fine putting grandma in one of these brand new parks.
Yeah.
And they build the homes, to HUD standards now, and they're beautiful, right?
Yeah,
Granite countertops, the islands that are bigger than my home's island in the kitchen. So yeah, they're quite nice, especially the newer homes and the newer properties.
yeah. Oh, yeah, I've seen some of them, some of the retirement communities, and it's like I could live there.
Yeah.
It's like I should buy one of these parks, and if anything happens, I'll just move into one of those, until I rebuild, because you
I
always
tried to
kind of,
sell my wife on that in the beginning. I was as a downside case, and yeah, yeah,
yeah.
it didn't work too well.
I get it. So we've talked about you being an operator and you buying and selling these. You've made a kind of a career change, or within the
Yeah.
company. Talk to us a little bit about going from an operator to an allocator.
Yeah, so one of the things I really learned with getting, boots on the ground, getting in the weeds on operating these things is that it's really hard to do it from 2,000 miles away. And it's hard to do it without paying huge salaries to people that are local.
Yeah,
So you can either do that, you can either decide we're just going to own parks in this regional market and we're going to pay and invest in the team and talent there, which is definitely a way to do it. But so when we were buying, I made the mistake of spreading out too thin, right? Because you fall in love with the thesis of the space. The tenant owns the home, right? It requires low capital, and we can run these things remotely. And while you can, it's very difficult to do. And it was much easier when you were buying 7, 8 cap rates, right? You had a
right.
very large margin. You put on debt at 4. I mean, this thing was they're kicking off a ton of cash. That's a big margin of error to maybe not have every little thing dialed at the property, which is not the right way to run these things. So I learned that lesson, and we narrowed in on being better operators towards the end of my experience as an operator. But I knew when we sold the portfolio that I was always going to be a better investor and a better partner, capital partner, than I was going to be an actual operator. So while I know how to run parks, I could do it if I wanted to. It's not what I want to spend the next 30 years doing, running a 30-person property management team. I'm more of a investor by heart. I love the space. I love putting money to work in it, but I like to do it with partners who are the boots on the ground in North Carolina, in Texas, in Montana, in the markets that we're investing in that actually have teams and portfolios there. That's really the way to run these things, is that somebody can get there in seconds, if a problem happens, versus getting a call about this huge water leak, over the holidays and being stressed out about it. I much rather prefer this phase of my career where we're partnering with operators and letting them do the heavy lifting, but coming along for the ride.
Yeah, yeah, I have a big smile on my face because yes, Memorial Day weekend, I had an 800-gallon
Oh,
water heater tank
yeah,
burst,
I know where you're
and
going.
I'm like,
Yeah, there goes my weekend.
there goes my weekend. There goes everyone's weekend that was staying at the hotel, and it's kind of nice being on that side of it. Um,
Yeah, yeah, it's
so
it's I get it. It's like the alpha is driven at the property level. You got to really what
yeah,
we're offering is the network, is the initial underwriting screen, it's the access. Sometimes we get better terms with our partners, right? Because we're
mhm,
big, we're bringing larger checks as a partner than your typical, accredited investor. And so that's what we're bringing value to our partners, our LPs, is they wouldn't see these deals otherwise, right? It's unless they were doing this full time and had been investing with operators for let's see 7 years now. There's I think 16 different operators I've worked with, and there's only 7 or 8 that I'm going to continue to work with out of that group. Not that the other 7 or 8 didn't do a good job. They did. We got good returns. But you just kind of narrow in of the style you like, and you
mhm.
can see firsthand how people run parks and do new investments, and so our current investors get the benefit of that as well.
Yeah, that's perfect. Ladies and gentlemen, Brad Johnson, co-founder, CIO of Vintage Capital. Brad, when they go to your site, they're interested. There's like, this is might be something I want to diversify with. They go to the website, which is what, and what are they going to find? How can they educational materials contact us?
Yeah, so it's vintage-funds.com. We're actually releasing our upgraded version of the website. We just went through a refresh next week. But yeah, they'll be able to reach out, ask questions, view our track record if they request it. They can get into the portal, review everything if they're a accredited investor. So yeah, they can learn more about the space. We try to put out a lot of education material because I believe in this space and want to see it improve, want to see people run these properties the right way. I think when I started investing, I was more like, oh, this is my little secret. And I want to be able to take advantage of this and generate great returns. And the older I've gotten, the more I realize now this is there's plenty for everybody, and like we all benefit if we run parks the right way and all learn the best practices. So that's what we try to focus on.
Brett, is there anything that I may not have hit on that you'd like to inform our listeners before we let you go?
No, I mean, other than just kind of repeating the thesis here is that I think that this country has a housing problem, and I don't see how we're going to fix it anytime soon. And so the nice thing about investing in the space is that we do add homes, we do expand parks. I think that this is a great way to generate recession-resistant returns while doing so in a desperately needed sector of our economy. And so I think people can feel good about what they're doing when they invest in the space.
Yeah, and I think most of our listeners will agree. For instance, all the new home builds around where we're at, they're close to 1 million, and even the middle size, the 3.2s are 6, 7, 800,000 now, and it's like, how can people afford that? We need more of the nicer affordable
Yes.
housing developments, not the trailer parks, ladies and gentlemen. These are 2 bedroom, 3 bedroom, nice homes. They just are in a park, that is, I don't even know why do you know why it's even a mobile home park? It should be just they should kind of change the name because
Well,
now
they
they've
should.
evolved.
Well, it's kind of funny because a lot of the industry, my colleagues will say, no, you can't call it a mobile home park. You got to call it a manufactured housing community. But the reality is that yes, that is true, but people call it mobile home parks. So I've stopped fighting that battle about 7 years ago. It just is what it is. That's what people know it as. But
That's
yeah,
true.
there's some truth to it for sure. I mean, the reality is that that's a declining supply of these things, and so the demand is through the roof for affordable housing, and yet we're not building anymore. So we like that space as an investment thesis, and we'll continue to play in it for the foreseeable future.
There you go. Well, Brad, thank you so much. Ladies and gentlemen, Brad Johnson, vintage-funds.com. Check it out if you're interested in the space. Have a wonderful night. Thank you for coming on.
All right, thanks, Michael.